Thank you. Good afternoon, and thank you very much. It's my pleasure to be here this afternoon, and I'd like to extend NCSL's gratitude to Delegate Nelson and Senator Hall and the rest of the committee for the opportunity to be here. As he mentioned, I'm with the Fiscal Affairs Program of NCSL, and in case you're not familiar with NCSL, I just want to give a little explanation about what we are. We're a national nonprofit organization. We're bipartisan, so our leadership switches party each year. This year, our president is a Democrat, Senator Debbie Smith from Nevada. Next year, it'll be Senator Kurt Bramble from Utah, who's a Republican. We're the National Association for State Legislatures and Legislative Staff, and as such, all legislators and staff are members of our organization simply by virtue of being in the legislature. We're based in Denver, although we do have a small Washington, D.C. office, and they focus on state, federal issues. In Denver, our primary service is the sharing of information. To accomplish this, we provide a forum through our meetings and our committee structure for state policymakers to exchange ideas. We also conduct a lot of 50-state research and provide information on state policy issues. So I work in the Fiscal Affairs Program and on tax issues, so that's why I've been asked to speak here today. So what I've been tasked with doing, and I understand you've already heard some of this, so my presentation will be a little bit shorter than I originally planned, but discuss tax trends, discuss some of the tax changes in other states, and then talk about what's happened since to the extent that we know. But before I begin, I want to bring some of our surveys to your attention. And I also want to give a big shout out to some of the legislative fiscal staff that we work with. Melissa and Mark and Fred over there. We survey staff, and that's how we get all of our information. And I know that they dread getting emails from us because it's going to be another survey, but we really do appreciate their work. And these reports are how we use that information. So the first one is our state budget update. It's a current snapshot of state fiscal conditions. We produce that about 2 or 3 times a year. And it's a short survey and just talks about the immediate outlook. The second report is our state budget actions report. And in that one, we talk about spending in all the major budget categories by state. And the report that I work on is our state tax actions survey, where we survey all the state fiscal offices and ask them to report all their tax changes in each calendar year. So these are the tax categories we use in our survey, and we ask them to report any change that provides revenues of that is a revenue change of more than $1 million. We also ask about property taxes, even though those aren't state taxes. We include that information as a separate appendix, and then we ask about some other non-revenue tax changes, or non-tax revenue changes, like fees or accelerations or increased compliance efforts. So this slide shows shows 20 years of tax changes from 1994 to 2014 based on our survey results. And you can see that the last time we had sustained tax cuts across the states was back when states had lots of money in the late 1990s. The cuts peaked in the year 2000, and then we had the recession following the dot-com bust and the terrorist attacks. And you can see that reflected by tax increases in 2002 and 2003 as states had to raise revenues to cover budget shortfalls. Then you can see that the tax increases got smaller in the mid-2000s as the economy recovered, but we never went back to widespread cuts. Then look what happened in 2009. We had the big national financial crisis and everybody raised taxes. And as a result of the last recession, states have closed about $500 billion collectively over about a two or 3 year period. They were primarily through budget cuts, but as you can see, they also raised taxes. And then it wasn't really until 2012 that we saw state revenues recover. The tax cut you see up there is a little bit misrepresentative, and I'll talk about that in just a minute. But the last couple of years, we've seen a lot of cuts. And before I go on, I do want to point out a couple of caveats about the interpretation of the data. And the first is that a tax cut is not always a tax cut. It depends on how it's measured. And there are two different ways to do this. And this concept's important to understand because it explains why the same activity reported by different organizations can be so inconsistent. So baseline is a method of reporting tax changes based on how they are written in current law, and taxpayer liability is based on how the change impacts the taxpayer. So the best way to illustrate this is with an example. So let's say there's a state that lost a big school funding lawsuit and has to come up with a lot of money quickly. So policymakers decide to raise the state sales tax for 1 year. It's going to go from 5% to 6%. But to make it a little more palatable, they decide that after 1 year's time, they're going to have a new permanent lower rate of 4.5%. But a year goes by and we're still not comfortable with the state budget situation. So they decide it wouldn't be fiscally prudent to go all the way down to the 4.5% rate. But they do decide to lower the rate to 4.75%. So the taxpayer's experiencing a tax cut, but based on current law, it's a tax increase. So, how do you measure that? I will tell you, most fiscal offices use baseline. We used to use baseline, but we switched to taxpayer liability in the late 2000s, mostly because states were implementing a lot of phased-in changes, and our reports weren't capturing that data. So we switched, and we used taxpayer liability. And so going back to this slide, I just want to point out another caveat about the data, and that's that the numbers that we use are net aggregate dollar amounts, so that activity in one or two big states can skew the results. Or sometimes tax cuts are canceled by tax increases in other states. So just looking at the total change doesn't necessarily reflect the activity across the country. For example, the tax increase you see there in 2012 is almost all the result of California. If you took California raised their sales and personal income taxes that year. If you take them out, then there would be a slight net cut from all the rest of the states. So tax trends. During the years of the downturn, which for the states was 2009 and 2010, these are the trends that we saw. We saw a lot of states using temporary tax increases. We saw a lot of states targeting high-income earners through new tax brackets and also through sales taxes on luxury items such as boats, expensive cars, furs, jewelry, that sort of thing. And then we also saw states look to broaden their tax bases. Policymakers were scrambling to plug their budget holes, and they started to take a look at all the tax exemptions and credits that they offered. And in other cases, they broadened their tax base by establishing nexus for online sales. Those are the Amazon taxes you hear about, and also made more services taxable. So since 2012, and that's the year that most states went back to peak revenue, this is sort of what we've been seeing. Cuts have focused primarily on business taxes and personal income taxes, and we've looked at states continuing to broaden the tax bases. So this slide just shows the states I included to talk about, and it was very hard to select states because there's been so much activity in recent years that pretty much every state has done something. So I tried to focus on states that did more than just cut rates and look at states that enacted their tax changes a few years ago so that we could have so we could look at what has happened since. Now that being said, I wasn't here this morning for the Tax Foundation's presentation, but I was looking through their handout, and it looks like they covered a lot of these. So I'm just going to kind of skip over that. So I figured that's probably good news since it's a long day of tax reform discussion. Yeah, I will. Okay. So the state that everybody's been talking about is Kansas. And I think that Joe probably went through what they did, but you can see that's the famous quote from Governor Brownback about the pro-growth tax policy will be like a shot of adrenaline into the heart of the Kansas economy. So what I did is, well, and this just shows the projected budget shortfall after the cut, and it's still something that they're grappling with. But so since the reform, so I talked to some of the legislative staffers there, and so what they said is they faced budget gaps every year since the tax cuts. They had a pretty healthy rainy day fund, so they were able to absorb some of the revenue loss by tapping into the reserves. But they're anticipating a budget gap this year, well, for FY16 of $422 million, and that's after they already transferred from the Highway Trust Fund, so it was $700 million. And they're still working now to try to figure out how they're going to close the gap. So what they said is the current legislature is in the process of building a structurally balanced budget based on both revenue and expenditure adjustments. So they didn't rule out some revenue increases. The credit rating was downgraded by both S&P and Moody's, citing ongoing revenue concerns. And when I asked them about some lessons learned, the one thing, there were two things that they said. One was that there was a disconnect between the Appropriations and the Revenues Committee during the process, and it would have been a lot more beneficial had they been communicating all along. And then I think the big lesson in Kansas was don't do it all at once, especially if you're cutting a tax that provides a big chunk of your revenue stream. I mean, other states have successfully cut taxes, but they phased them in over several years, or they've targeted big cuts at taxes that provide a smaller percentage of state revenue, like the corporate income tax. And in some cases, they've built in revenue triggers that must be met before the cuts are implemented. And a good example of this is North Carolina. And again, I think that Joe sort of covered what they did, so I can talk about what happened since. So according to our latest survey, the North Carolina budget's stable, and according to the most recent revenue forecast, they expect to end the fiscal year with a $400 million surplus. And by the way, states, the fiscal offices have come back to us. We can't say surplus anymore. It's kind of become a dirty word. Right after the recession, when states were first starting to recover, we would say they have a surplus, and the revenue was, or the media was picking up on it, and so it became, all the vultures came out. Everybody wanted a piece of the surplus since budgets had been cut so much. So we now call it unobligated ending balance. So if you see our report, that means surplus. Unobligated ending balance. So in North Carolina, their surplus unobligated ending balance, it actually triggered their more corporate income or corporate rate cuts. So their rate's going to go from 5% to 4% in 2016, and then 3% the following year. And you can see from these quotes that I put here, this is sort of the difference of opinion about the impact of the cuts. The proponents feel that the cuts have helped grow and stimulate the economy, and then critics argue that the cuts negatively impacted low and middle income residents because of the nature of some of the deductions and credits that were eliminated. And this is just this was just something I saw that sort of reflected the mood early on in the year. Okay, so I wanted to come back and just talk for a minute about tax triggers, because the use of triggers can be a good way to implement tax cuts and at the same time ensure that the state is able to absorb the impact. They also put the tax change on autopilot and remove some of the policy debate, which can be both a good thing and a bad thing depending on what happens and your particular perspective about that. But many states have used triggers over the years, and we just talked about North Carolina. I also wanted to mention Oklahoma and Missouri because both of these states enacted legislation last year that included triggers. The Oklahoma measure reduces personal income tax rates in 2 phases, the first in 2016 and then again in 2018, but the cuts are contingent on certain revenue triggers related to general fund projections and whether or not they exceed projections from the previous year. And that trigger has been criticized for being tied to a meaningless revenue target because it's not based on whether collections actually just go up just on the forecast. But they did announce early this year that they met the target and the rate cuts have been triggered. So the top rate's going to go down in 2016. Missouri also approved a rate cut last year, beginning in 2017, if general revenue collected in the previous fiscal year exceeded the amount of general revenue in any one of the 3 fiscal years prior to the tax increase by at least $150 million. So, and just a note, that was vetoed by the governor, but the legislature was able to override it, and so it's on the books now. It's too early to know yet if it's been triggered because it wouldn't go into effect until 2017. Okay. Oh. Whoops. Oops. Okay. So Indiana, and again, I think that this was one of the states that Joe talked about, so I'll just talk about since the reform. So they're in pretty good shape. They have a balance of $2 billion, which is primarily the result of the big spending cuts that they made during the recession years, and then the states held spending growth in check to maintain that. So they've carried that for a while. They're seeing corporate income taxes grow as the result of a strong economy and corporate profits. And when I talked to the analyst there, though, he did tell me about one unintended consequence that was worth mentioning. And that's Indiana gives local option, they give counties the local option of income taxes. And they're finding that as the state rates have gone down, the county rates have gone up. So in most counties, the income tax rate is now between 2% and 3%. So it's offset a lot of the state cuts. But when I asked about lessons learned, he gave me two bits of advice. He said, one, they phased in the cuts over several years, so it gave them time to absorb the impact. And 2, that they made the big rate cuts in revenue streams that were not big sources of income, like the corporate income tax, and more modest cuts in the personal income tax because they rely on that more heavily. And I think a lot of people think that's where Kansas ran into trouble. They cut a big portion of the total revenue stream. Okay, so Ohio. Ohio's interesting because it's a state that's gone through a number of state tax reforms. Going back to 2005, they made sweeping changes to the tax structure with a number of reforms scheduled to be phased in over 5 years. The biggest development was that they enacted a new business tax, the gross receipts tax we heard about before, called the commercial activity tax. It's a broad-based transaction tax of $2.60 per thousand in sales levied on gross receipts in excess of $150,000. And then in exchange for that new tax, several other taxes were reduced. They phased out the corporate franchise tax. They eliminated the personal property tax. Because the property tax is a local tax, they agreed to reimburse schools and local governments directly for a while for the loss in revenues. And the tax reform package also cut state sales taxes by 0.5% and raised cigarette taxes. And finally, it reduced state personal income taxes by 21% over 5 years, although the legislature did have to postpone the scheduled reduction in 2010 because of the budget crisis, but they went forward with it the next year. And the reasons that they gave for this tax reform at the time was to modernize what critics felt was an outdated tax system with very high income tax rates. The supporters of the CAT felt it was a way to make the tax code more fair and broaden the tax base, and that the elimination of the personal property tax would be a big boost to heavy industry. So the question of what happened after it was implemented is tough to answer, mostly because of the timing. The first and second years showed positive fiscal conditions and revenues were in line with estimates, but then came 2008 and the economy bottomed out and had a huge impact on state finances. So it's hard to know what really happened based on those tax changes. But I can tell you that a lot of people really dislike the gross receipts tax because it's a transactions tax and it's levied at all levels of production and results in tax pyramiding. On the other hand, economists like it because it's broad-based enough to keep the tax rates low. So then moving on to 2013, Ohio goes through another round of tax reform. They cut personal income tax rates by 10% over 3 years. They increased the small business income tax deduction so that allows pass-through entities to deduct their income below $250,000 by 50%. It imposed a $30,000 income limit on the $20 personal exemption credit. And then to offset the cuts, they increased the state sales tax rate from 5.5% to 5.75% and expanded the base. They also established a means test for the existing property tax homestead exemption so that it only applies to low-income seniors. Then in 2014, they accelerated the income tax cut so that it was fully implemented in 2014, a year early. Okay, so Ohio, since the reform, despite all the reform, they're still considered by many to be a high-tax state, and a lot of businesses don't like the gross receipts tax. The budget picture in Ohio is currently stable according to our winter survey. The budget talks underway now include more tax reform, and Governor Kasich has gone on record as a proponent of trying to eliminate the personal income tax. But it would be tough in Ohio. It provides about $8 billion in revenue. And we've seen a lot of governors talk about trying to eliminate the personal income tax, but they quickly find out that it's hard to do because states rely so heavily on it, and there are philosophical arguments about the fairness of income taxes vis-a-vis other taxes. And just FYI, you've probably already heard this, but there are 9 states that don't have broad-based income taxes. And of those, only 1 repealed it once it was enacted, and that was Alaska in 1979 after they created the Permanent Trust Fund. So the states that don't have it have never had it. Okay, so New York, I know that was another one that Joe already talked about, so I don't really want to talk about it too much. This quote is from our current budget survey and sums up the fiscal situation in New York. They actually had a good problem this year in that they received a big windfall of more than $5 billion from settlements with big banks who were charged with helping taxpayers evade taxes. So Michigan. Michigan's another interesting state because they've had so many different reforms. Back in 1975, they adopted the single business tax, which replaced 8 other business taxes and worked like it was a value-added tax. And then in 1994, they enacted a major school finance reform where the state picked up 80% of school funding, and they reduced school property taxes by about 33%. And to finance their share of the burden, they raised the sales tax from 4% to 6%. They also adopted a statewide property tax for education. So Michigan's one of a handful of states that has a statewide property tax. So then in 2007, they repealed the VAT tax, the single business tax, because over time the tax base eroded with deductions, exemptions, and credits, and it moved away from its original value-added concept and became very complicated and unpopular. So in its place, they enacted the Michigan business tax, which consisted of a modified gross receipts tax at a rate of 0.8% and a business income tax of 4.95% levied on all business entities. And then it also included a 21.99% surcharge on tax liability, further increasing the tax burden. So they replaced it with an even more complicated tax. So in addition to the complicated multiple tax bases, it also contained over 30 credits, resulting in tax expenditures of several $billions each year. And one of the fiscal staffers there told me they expended more in credits than the amount of their entire general fund budget. So it turns out that the Michigan business tax became even more unpopular than the tax that it replaced. So then in 2011, only 4 years after they enacted the MBT, they enacted another reform measure and implemented a flat 6% corporate income tax. And they eliminated all tax credits except for the small business credit. And at the same time, they raised personal income taxes by broadening the base, even though there was a slight rate cut from 4.35% to 4.25%. But the biggest news out of this tax change was the elimination of all the credits. And this is Governor Snyder calling the MBT the dumbest tax in the country. But the shift to the flat tax hasn't really worked as they intended, and that's because when they repealed it, they allowed businesses to continue claiming the credits as long as they kept paying the old Michigan business tax instead of the new corporate flat income tax. So they found that a lot of businesses have opted to continue paying the MBT because of the credits, even though they hate it. The value of the credits means that much to them. But there's an effort now to put a real end to it. And these are just a couple of comments from supporters of the legislation circulating now that would put a final end date on the MBT. So the other tax reform efforts in Michigan also continue. Last year, voters approved a measure to phase out most of the personal property tax over 10 years. And then just a couple weeks ago, voters decided on a transportation funding measure that would have generated new revenues. However, it failed by a large margin. And there's all kinds of theories about why it failed, ranging from it was too complicated to the fact that it would have raised money for services other than just transportation. So when we asked about the current outlook, the legislative economists told us that revenues are generally on target, but tracking them is complicated because several business tax credits are expected to reduce revenue significantly, and it's unknown when these revenues will be posted against, or when these credits will be posted against revenue. And that gets back to the MBT tax and the credits. And this is a bit of a side note, but I thought it was really interesting, and it's one of the few positive things I've seen written about Michigan in recent years. This was an article that was just published in State Line last week, and it contained an interactive map showing state job growth since the recession. And they calculated job growth by looking at each state's lowest level of employment since January 2008 and comparing it to March 2015 employment levels. And the article concluded that Michigan has been the biggest success story because Michigan fell lower than any other state during the recession, but they've since added 417,000 jobs since the low point in March, which for them was March 2010, placing it high in overall unemployment growth. And you can see from the map that North Dakota experienced the highest percentage growth thanks to the oil boom. Employment there has jumped 28%. Other top performers are Texas, Utah, California, Colorado. And the other thing to keep in mind is they don't qualify what kind of jobs these are. I mean, they could be high paying or low paying, we don't really know. But I just wanted to bring this map to your attention because it was just published last week and it's pretty cool. You can hover your cursor over it and it gives you all the details about each state. Okay, so Rhode Island, another state that's gone through several rounds of changes. And again, I think that Joe touched on what they actually did. And as a result, they have a much simpler tax. At one time, they had 20 different brackets. So they have a much simpler system now than they did. Arizona is another state that passed legislation to reduce business taxes, and I just wanted to bring it up here because I think it's interesting that there was a 3-year delay in implementation. They enacted the legislation in 2011, but didn't implement it until 2014. And the idea behind waiting several years before the tax cuts took effect was twofold. One, that Arizona was hit particularly hard by the crash in the housing market. So by delaying the tax cuts, it allowed the state time to build up its rainy day fund as the economy improved and revenue increased. And the second reason they gave was it gave government officials time to start shopping the tax cuts around and getting the word out to out-of-state businesses, particularly the high-tech businesses. They were seeking that Arizona is a low-tax, business-friendly state. DC, I'm sure that Joe talked about DC because that's a reform measure that nicely balanced, and they actually really changed the structure. And this is actually in honor of them, and it's an image that shows the impact of the new sales tax on gym memberships, which is what received all the press, is how that's outweighed by the benefit and the income tax cuts. And lastly, I wanted to end with Illinois because no matter how bad the budget situation seems in other states, it's a pretty sure thing that Illinois is in worse shape. They have some serious fiscal troubles that go way back. And I think that, again, Joe talked about the details of what they did. But now they are facing $6 billion budget shortfall for the next fiscal year. They still have unpaid bills, and the pension liability grew. This quote here from the governor sums that up. And now they're battling it out over the next few weeks as they try to balance the budget, what they're going to do. And this is the comment that we just received from the Illinois Fiscal Office in our last survey just a few weeks ago about the unrelenting budget pressures. So what's on the horizon? The near-term horizon, I think we'll see a lot more income tax cuts and corporate income tax cuts. The longer term, I mean, we think that sales tax expansion is inevitable as the base continues to shrink relative to sales, as spending on services and online purchases continue to grow and erode the sales tax base. More income tax cuts, as we've already discussed. I mean, this tax provides very little state revenue relative to other tax streams. Plus, there's a lot of political appetite to lower business taxes. More and more states are paying attention to credits and exemptions. I mean, 5 or 6 years ago, most state lawmakers didn't even know what their tax expenditures were, and if their state produced a tax expenditure report. And now we see policymakers demanding them and creating special tax review committees. And interestingly, Oregon created a special committee that's just called a tax credit review committee. And they created it in 2009 as a result of a runaway tax credit that was going to bust their budget. And now every 6 years, all tax credits get reviewed, and any new tax credit has to have a stated policy goal. And then in 6 years, the tax credit review committee will review it and see if it met its goal. Another thing that we see on the horizon are changes in transportation funding. I mean, gas tax is no longer providing enough revenue, and states are starting to get creative with how they're going to fund their highways. Forecasting volatility. This was something that just came up. We had a conference call the other day with some legislative fiscal officers to talk about agenda items for an upcoming meeting. And one of their concerns is there inability to accurately forecast revenue, and it's getting worse. And they don't really know why, but they were blaming it on the millennials. They're saying that their residential and consumer behavior is much more erratic than their other generations have been. And lastly, the next economic downturn, when that will be. Historically, about every 10 years or so, but it feels like states have just recovered from the last one, so we don't really like to think about that. So, and I think that,